Good evening, everybody. Welcome to Finet SG with Xian. Today we are on episode 9. It will be my final thoughts on SG Engineering, a place where my father worked for 35 years before he was asked to retire 2 years ago. So very interesting. And first I introduce myself because we have a new friend here today. So I'm Xian and I'm in the business of investment risk management. And I was a client of Unicorn for 5 years when I was 25. And with $25,000 through Unicorn's partnership and also close guidance and really good relationship with them, it helped me to amass to $200,000 worth of assets. And because of 2 trigger events in my life, I actually wanted to come into the business, investment risk management, to really cater for beyond myself, to create wealth for not just myself, but for my parents and also for my loved ones and friends and their loved ones and friends. So this is me, and I'm Xian from Finet SG as well as Unicorn. Welcome. And just to give a structure very quickly, I started off on the 9th of May, and now I'm moving on to a weekly 20 to 25 minutes. And today we have a bonus, and the bonus is on 1 question. Okay? Disclaimer, always understand that this is purely for informational, and if any questions you would like to have, please come to me directly or have a question towards and contact me for questions, most important. Okay, I always begin with this question, but I never actually asked you guys for answers. So maybe tonight we will go through that. How do you go about deciding how much you are actually going to invest? Okay? So economy update. Since I'm a really sporty girl, lady, I want to talk about Nike. While Nike is laying off staff and announcing this $790 million loss already in the last quarterly earnings. So this is what some of the big companies are also facing, especially in the US. And US is a good proxy for us to understand because it has the biggest impact on the economy. So in terms of economy update, most likely whatever US is facing, we are also going to face. Some US states also reimpose COVID-19 measures because as the cases are spiking up. So yes, we reopened the economy. Last week we talked about that. Everyone was quite excited about phase 2 in Singapore. But now US is starting to have to reimpose their lockdowns or whatever measures they have. And likely things are going to happen as well as we are reopening the economy. Okay, then just looking at this chart to help us understand the severity of things, or at least the impact compared to 1991 and 2009. So 1991 is the blue line, right? 2009 is the yellow line. So this year, we're looking at the red line. So the decline is pretty sharp. I would say really, really sharp. It's really falling off the cliff. And that's all I'm going to say. And we have a potential game-changing event coming up. Paycheck Protection Scheme is actually ending today. And this $600 per week unemployment insurance is coming to an end of next month. What does it mean to the world, or at least to us? Is the fact that at this moment, the government is still trying to cushion us into the situation. And you can only imagine the impact when this cushion is over, because like I mentioned quite a few times, it's like Mike Tyson trying to really knock out the opponent is the pandemic in one round. But however, the round 1 is about to be over and Mike Tyson is exhausted. So this is the scenario that we are facing at this point. So in terms of financial markets, I wouldn't share much more because changes in equities, just to keep it in mind, at the moment it's going up and down. So if you are wondering, especially as a new beginner as an investor, you will be wondering whether it's going up or down. It's not going to be easy at this point in time because of the disconnect between economies and financial updates. So anything you're unclear of in terms of the terms I use, you can always go to my YouTube channel and understand from the previous chapters and the series. If not, yeah, you can always drop me a message, okay? And we've spoken about this, how to protect yourself is really looking at holding an amount of cash and gold, and we have our reasons for that. And also, cyclical growth companies still going below the water because of the economy. It follows the economy. Out of the 4 types of companies I've spoken before, cyclical growth follows the economy. Economy bad, company go bad. Economy good, company goes good. So looking at this versus what we thought of as a structural growth company, it is important to take note, because I want you to understand. Let's say, if you recall, there is a term called Tina, right? The female name Tina. It just means there is no alternative. And what do I mean by that is, even if you don't invest today, my friend, and your neighbor is the one who invested, and you both hold $100,000, so you keep it as cash, and your neighbor invests and happens to invest in a structural growth company. Okay, maybe 5 years later, to keep it an illustration simple, 5 years later, and your neighbor managed to invest in something good that goes up to 5 times the price. So your neighbor gets 500,000, that's $500,000, versus if you don't do anything, that will be a clear understanding that even if you don't invest, you will happen to be the loser. Why am I saying that? It's simply because money has been printed. As we all know, the US federal government has printed $2.6 trillion. So I'm not saying that, it doesn't mean that it won't go 5 times. Because the money that is printed is so much, it doesn't go to the man on the street. It actually goes back to the asset markets. And logically speaking, a smart investor, a normal investor, after looking at a lot of quantitative analysis, which we will go through later for ST engineering, they will eventually go to quality companies. And where do all this money flow? Flow to good companies. And it's quite easy to understand, it will grow. It's just by how much. So if you don't do anything about it today, you might need to ponder what you're going to do at this point in time because of Tina. Okay? Important investment decisions. First, we look on the picture on the left, asset allocation. Are we going into equities, bonds, commodities, gold, or cash? And you have to decide what is the weightage for each of them. So these are already quite big investment decisions. Then we look into asset selection when you have finally chosen, I want to go into equities, or I want to go into bonds. Very, very good to find out what are your fundamental reasons. Because in the first place, when we come together to share about this financial wisdom, it's not just, investment information. It's literally achieving your financial objective. At the end of the day, why do you invest? Very importantly, so after you have selected the equities, then we look at these 4 types. Cyclical growth, mature and stable, structural decline, structural growth. Very important. I like to re-emphasize on this to help you understand that there's a potential game-changing events coming up. Because of the expiry of the paycheck that is coming on today, and also the fact that a lot of money has been cushioning the economy. So this was one important point. And then in terms of financial markets, I won't go through this anymore because it's up and down. But most importantly, looking at this is what I was talking about. So to give you another understanding. So picture on the left, asset allocation, all right, and asset selection. Okay. Then I move on to the case study for our own final thoughts on ST engineering. So this is really the crux of what I want to share today. So enjoy understanding a company that my father used to work for 35 years. I really feel a lot for this, and very good things that I will share today. So 4 types of companies, we always look into it. Then we look at ST engineering being the stable and mature companies. What is SG engineering about? It's actually into 4 different segments: aerospace, electronic, land, and marine. So aerospace Yeah, it is in the aviation industry, of course, and they are stable in a sense because they are quite strict when it comes to situations where there's life and death involved. So like medical and aviation, there's very strict regulated rules on it, which helps companies who are having this kind of contracts to have a stable revenue and profit. So that is just helping you to understand a little bit deeper why we chose ST Engineering as stable and mature. Okay, looking at this is easier to understand. The biggest sector we look at is aerospace, then electronics, then you see the land and marine. Marine is quite small, so we won't really talk about it. But this was shared last week, but just to give you all a refresher on how ST Engineering is as a company. This one is also helping us to understand. For 2 weeks, we have been going through the past, looking at all their 10 years profit growth and helping us to understand what is it now, their profit growth during difficult economic environment. And also, presently, what is the near-term outlook of the company and how COVID-19 is affecting the company. Then today, we'll be talking about the future long-term outlook. So how will engineering, ST Engineering's earnings be affected by the crisis? Just a quick look. So last week we talked about this for record high order books, diversification. And even though there's lower revenue, they're still able to support the dividends because they have actually grown quite a lot in 2019. And just that this year it has fallen again, but still enough buffer from 2019 profits to provide dividends. So in terms of looking at it as a dividend stock, it's still possible. So the next thing is, will ST Engineering actually run the risk of being disrupted? It's important for us to find out because this is the first of the two questions I want to ask and helping us to understand ST Engineering a bit better. Because the biggest risk of stable and mature companies is that they might face disruption. For instance, if you look at telco, Singtel, StarHub used to be stable and mature. But what happens when the fourth telco comes in? Wang liao lo. Because there's a price competition, right? Firstly, they start to fight in the price war. Then, not only that, then they start to, their business model also was not very stable in that sense. That is not really for the future, the environment. And they start to be structurally losing. So they fall into the next category of structural losers. So when you can be very stable and mature to a certain point, but you have to be careful when you analyze the future of the businesses, which I will carry on towards the end on how Mr. Warren Buffett has tweaked his own philosophy about this as well. So we focus on SG Engineering, okay? Whether it will face the risk of disruption. So looking at the four sectors again, the first one, aerospace, like I mentioned just now, tightly regulated industry. So there is still a huge maintenance contract for all the aeroplanes. So it crosses a number of hours, right? You are asked to do servicing because it's tightly related to politics. You know, you don't want to be in a country where there's a lot of aeroplanes that are faulty or causing a lot of life and death issues. So in terms of that, they're very strict. So after a certain number of hours, must go for servicing. And aerospace is the space, is what ST Engineering is earning from a lot. So in terms of that, electronics. You know, in terms of electronics, I can feel that they are more on the leader, the disruptor of technologies in their engineering capability. Because so that means they are facing lesser risk. Land as well. Last week we talked about autonomous bus on Sentosa. So they are also on the leading edge at this point in time in Singapore. And because of that, they are again more the disruptor. So not a very big risk in terms of being disrupted. And marine, again, not a very material contributor, so I won't talk about it. Okay, so my conclusion would be there is a low risk of threat of disruption or even more intensified competition in the near future. simply because a lot of contracts are from the government. It was the high 30%, right? As I mentioned last week. Secondly, they are also on the leading edge for two of the sectors. And thirdly, is aerospace. They are also asked to service after a certain number of hours. Then how about the prospect? So that's the second question. How is the prospect of ST Engineering? We look at two things, near term and long term. Near term, unfortunately, there is a very big part that we need to talk about, right? Aviation. Yes, we need to do servicing, but it's a demand and supply thing. If the planes are not flying, of course, they're not clocking the hours. Personally, I do have a relative who is from SIA, and he has reduced his job, the number of hours. So that is the truth of aviation, and that means the jobs and the servicing contracts are also reduced. So that talks about the maintenance, repair, and operations. And in terms of electronics, it's also delay, not cancelled, but delay in the implementation. As what the Minister Chan Chun Sing has mentioned, projects, some tenders has to be delayed because it's according to demand and supply. So at this moment, there is probably a slower growth in the near-term prospect. How about the long term? Long term is quite promising because in 2018 there was actually a 5-year growth plan, and the vision is pretty large. Want to be in a global technology, defense, and engineering powerhouse. Almost sounds like a music industry. But in terms of growth, their core business want to grow at 2 to 3 times its annual GDP growth. So last week I've mentioned how they have been growing, right? So over 13 years is 22%. So when you say 2 to 3 times, on the average, we're looking at 5 to 7.5% per year. So that was their aim. And also maybe because it's the fact that they acquired a few businesses and the profit actually grew by 17% in 2019. That's why I mentioned about this bigger revenue and bigger profit. It was the profit is actually aligned with the revenue as well. So growth in revenue, also growth in profit. So well maintained, I would say. And also they sign contracts for smart city. They are heavily involved in that. So from 1 billion in 2018, they are intending to grow double the size by 2022. It may be a slower growth at this point in time, but 2022 is still some time away. So about 15% per year. That's what they're looking at. So understanding the fact that there's a low risk of being disrupted, and they are also having this 5-year growth plan, they might be advancing themselves to become a structural growth winner. So why do I say that? It's because they will need to, looking at profitability, the profit to grow in tandem with the revenue, right? So it just means that the PE ratio could be re-rated. In that sense, not just value as a dividends company anymore, but it could also have moderate growth because of their visions and also their acquisitions, and they can command a higher value. So there might be, besides a dividend growth for yourself, also a capital appreciation on the stock price. That is the outlook of it. Okay? So again, the question is it a good time to buy into a mature and stable companies, especially looking at ST Engineering? We take a look at the valuation because for instance, valuation, how do we look at how companies are actually good? That's the historical PE ratio is actually one of the methods that we use to understand is it valued above average of how they have been doing so in their PE ratio. That is one thing. So SG Engineering's PE ratio could be re-rated as I mentioned because they show consistent growth in their earnings in the years ahead. So that just means that it will become higher value in terms of their stock price as well. Okay? My take on SG Engineering towards the end. So the good on the left, stability from diversified businesses, but remember, it's a double-edged sword. But management also appeared to be more on the growth-focused side, 5-year plan, low threat of disruption, and good dividend yield of 4.5% per annum. So the only thing that we don't really like is because it's still project-based businesses, like what Minister Chan Chun Sing, the moment they need to do a delay, then you also have to delay your revenue. So instead of having a recurrent income, that is probably something we're not comfortable with. But the growth is still expected to be 5 to 7.5% per annum, low to moderate growth. And most of its free cash flows are paid as dividends. So if they really need to go into acquisitions, it will be largely financed by debt. Only one small hint would be SG Engineering is a high quality company. So if they go on a debt, it might be a very low interest for them, and to be able to borrow at quite good rates. So there is a small hint of silver lining. Okay, so in conclusion, so if I were the one deciding, these are just my own opinion, I will have a small portion of my equities of portfolio, really 2.5 to 5% in SG Engineering. If I want to have steady dividends to start with moderate growth over time. Because currently, looking at my previous case study with DBS, definitely I would prefer SG Engineering on this. Because the long-term prospect is less at risk. Simply because of that. Because DBS, cyclical growth. However, the last part, I would really like a larger part of my portfolio in structural growth companies with annuities like recurrent income. Structural growth is like double-digit growth year on year. Sounds easy to just choose, I want a structural growth company. But this is the one thing I want to share with you as the last part. I shared quite a few times about what we can do as an investor seeking higher grounds, because we're not certain what is the economy and the financial markets going to turn out at this point in time, because pandemic, vaccine for COVID-19 is still not here. And how we're going to seek higher grounds is based on what I mentioned, how to protect yourself. So this part, I do want to answer. Actually, how do you know when is a good value to buy into the companies that you actually want? Then I go back to how Mr. Warren Buffett has evolved in terms of his understanding as a value investor. So the first one, I won't go so deep anymore. If you want more information, you can come to me. He has his mentor, Mr. Benjamin Graham, on the Intelligent Investor. If you want to think of that as the first step on the left, if that's the book, is talking about assets. Because he personally has gone through the Great Depression at that time. And for his mother to actually get a loaf of bread on credit at that point in time, the shopkeeper actually asked her, "Are you good for $5?" So asking his mother, is the mother able to pay back the $5? So his motivation is never to be bankrupt. And from their understanding, right, so he has very strict and well-defined lines of how to value a company. So let's say, looking at a company that is worth $1 million in terms of assets. So if you want to have a margin of safety at 60%, so it's a very defined line. Anything below 60%, it is worth to buy already. Anything above that, an investor won't actually go and get it. So very well-defined line. But as we move on into the era, even up to the third one where they talk about pricing power, moat, quality business. So this is what Mr. Warren Buffett has evolved. So high return on capital and non-cyclical. So he would still choose to buy mature and stable companies that may be priced quite well, still a pretty good margin of safety, but less defined lines. And to ensure that there's at least 5 to 10% growth year on year. So as cheap as possible, yes, but also make sure there's another criteria now, 5 to 10% growth. How about now? In this era, Today you look at this, it's compounding machine, worldly wisdom, reasonable price, low capital intensity. So what do we mean by that? Okay, so it definitely has to be a great business, not just a good business anymore. And a compounding machine, which actually speaks of a structural growth winner. And if the price today is still pretty high, but is of a good value. So for instance, if you actually look at a company that can promise you 20% perpetually year-on-year growth, then I can share with you, hey, no price is unreasonable. Because if you hold on to it year-on-year 20% compounded, it can be very large. So you can pay any price today and hold on to it, it will still be a lot in the future. So this is what it's going to be now. It's not just looking at the tangible data, financial data. That's very, very important. But that's what we are all used to in the past. And it's no longer fitting to this digital disruption evolution. Because the last disruption was industrialization era. So this is pretty far away already. And there's a need to tweak on the philosophy of it. So if you see a company that is pretty good like Microsoft, but it's quite high priced at this point, up to $200 already today. And if you don't get it, then perhaps next time it will be, I don't know, $1,000. So that's something to consider for sure. Now as a value investor, it's not just about this defined line of its valuation. You also look at the intangible considerations, looking at its future of the business, something that we're still trying to be more comfortable with, together with understanding all the financial data and also the valuation of it. So this will help us to understand how we can go about understanding a little bit more about how to invest. Okay, and this is the services that Unicorn provides to really go in depth. First, in depth, just to understand. First, to really take care of your own contingency needs and also risk transference, anything that can derail you from your wealth accumulation. Before we talk about all this, I will call it worldly wisdom already, to understand how we can actually decide how much are you going to invest. I like him very much, so I'm going to share this one more time, because it's not about spreading it into the various baskets, but more so understanding why you are investing, what is it that you're looking for. In Unicorn, our intention is to create wealth. So whatever we research on, especially on the quality companies, is to create wealth, never diversifying for the sake of diversification. Okay, little bit short on time. I will just share with you what I do. Advisory on cash flow management and budgeting as the first step to really have all the things settled between contingency and risk transference, so that you can invest with a peace of mind and create wealth with a peace of mind, not just invest. And advisory on optimizing resources, on how to increase your overall returns on your assets. That is very critical, my friends. Then next episode, I will see you on Tuesday, 7th July. Definitely we'll share a little bit more on economy updates, because on July onwards we may be able to see the results already of actual GDP growth. Then case study on Singapore Press Holdings. So which category does it belong to? Okay, if not, thank you very much guys. Any questions, you can always scan the QR code to drop your questionnaire. If not, you can also meet me over a Zoom session, 20-30 minutes, anything, to address your questions. If not, you can always look for me over here. Okay, if not, I see you next week guys. Have a good evening.